A very wise investor once said, "The stock market is a device for transferring money from the impatient to the patient." How can you stay calm when everyone around you is freaking out? Let's discuss that today. Welcome back to the channel, everybody. It's me and this is the show. A couple weeks ago, there was a bloodbath in the stock market. Investors were losing billions of dollars in real time. And this caused one of my subscribers to reach out to me with the following message. It read, "I saw your video from last year saying that I should end worrying about this kind of dip in the market. But now it's been a week and it's not getting any better. So what do you think? This is exactly why we created our free newsletter. It is called Market Briefs, and we send out a weekly recap of the most important news stories that impact the stock market. As soon as you sign up, you lines also get access to our private Discord community where you can chat with us and other finance enthusiasts just like you. And now let's get back to the video. Listen, when things are going well, everyone thinks they are a genius. They think they have an edge in the market because they read a few articles on the internet. When the market takes a downturn, however, you quickly realize who the smart people are. You know, the ones who remain calm and collected while everyone else is running for the hills. If you want to become one of those people, then keep watching. Point no. 1 is understand the difference between fear and greed. In the book Think and Grow Rich, the author Napoleon Hill famously wrote, "Fear is the opposite of faith. And the person who experiences fear cannot simultaneously possess faith." This means if you're feeling fearful, you cannot at the same time feel confident or believe in yourself. Fear causes you to make stupid decisions. We've all seen these kinds of investors. These are the people who buy high and sell low. They panic and sell during a bear market, then chase returns by investing into the hottest stock that they hear about from their friends. The problem with these kinds of investors is they never look beyond their emotions. They let greed control their actions. When stocks are rising, they fear missing out, so they invest in something without doing proper research. Then when the market corrects, they feel fearful, so they sell off everything. Instead, successful investors base their decisions on facts, not emotions. They plan ahead and then execute on their strategy without hesitation. But sometimes even the best investors in the world get caught up in their emotions. Take Warren Buffett, for example. He once said, "The first rule of investing is to protect your capital. The second rule is to protect your capital, and the third rule of investing is to protect your capital." Despite being the wealthiest investor in the world, he still holds himself to the highest standard. On May 6, 2008, Buffett made a terrible mistake by investing in a company called Dexter Shoes. At the time, he thought that he was buying a good deal because the company was trading below its net asset value. But he didn't dig deeper into the accounting statements and realized that Dexia had overvalued its inventory by over $200 million. To make matters worse, Buffett didn't sell right away. He held on to his shares for another year hoping that the company would turn around. But instead, the price kept falling and eventually he had to write off the entire investment. Even billionaires aren't immune to making mistakes. The point here is that no one is perfect. We all have flaws and sometimes our emotions get the best of us. But the important thing is to learn from our mistakes and to be aware of them. Moving on to point no. 2, which is don't fight the Fed. What I mean by this is that you need to pay attention to the central bank policies in your country. Usually when they raise interest rates, the economy slows down and companies start reporting lower profits. That, of course, leads to a drop in share prices. On the other hand, when the Fed lowers interest rates, businesses expand and the market goes higher. That's not always the case. Sometimes the market has already priced in the future rate hikes, and by the time the Fed actually makes the announcement, the share prices have already reacted. Other times, though, it does have a huge impact. For example, when Jerome Powell announced the rate hikes in 2022, tech stocks fell tremendously. This is because higher interest rates meant that growth companies were going to be more expensive to fund. After all, these businesses borrow money to operate. They use that money to hire employees, expand to new cities, and develop new products. So the more money they borrow, the slower they grow. But since then, the Fed has changed its tune. They've paused rate hikes to allow the economy some time to catch up. And you better believe that the market reacted positively to that. I'm not a financial advisor and this is not financial advice. All I'm saying is that if you want to stay calm during periods of volatility, you need to educate yourself on the forces that are driving the market. Point no. 3 is to consider the bigger picture. Let me tell you a story. There was a farmer who had a horse. One day the horse ran away, so the farmer was upset. His neighbors came to console him and told him to be happy because he hadn't lost anything. He could have lost his life while trying to catch the animal. The farmer replied, "I may have lost my life, but I haven't lost hope. I will find my horse." A few days passed and the farmer found his horse in a nearby field. He was overjoyed. Then his neighbors approached him again. They told him to be rational and reasonable. Why was he so worried about finding his horse in the first place? After all, he wasn't going to die from hunger. The farmer responded, "You may be right, but it is not okay to lose hope. My horse is a part of my life and I cannot imagine myself without him. He's more than just a source of income or transportation. He's my friend." We all love to zoom out and say, the market is at an all-time high, ignore the short-term fluctuations. But when you zoom in, you only see red candlesticks. It's very easy to forget the bigger picture. In reality, there's nothing to be concerned about. If you invested in a diversified portfolio of index funds, I can almost guarantee you that if you wait long enough, your investments will recover. But the hard part is waiting without selling. Don't be that guy who says, "I am gonna hold on until the end of time," when they really mean, "I am too scared to sell." Of course, I'm not suggesting that you gamble your life savings and then say, "Oh, it's just a short-term fluctuation, right?" My point is that you shouldn't base your decisions on how you feel today. If you want to be a successful investor, you need to keep calm and carry on. Next point, which is take a break. Most of us work hard throughout the week, so it's important to take some time to relax. When we come back to work, we are able to focus better and make better decisions. Plus, it helps us avoid burnout. Here's a list of things that I enjoy doing in my spare time. I play sports such as basketball, soccer, and tennis. I go on walks and hikes and I eat good food. I also try to read self-improvement books and listen to podcasts. Taking a break doesn't mean that you have to stop thinking about investing entirely, but it does mean that you shouldn't spend all your time worrying about your portfolio. Instead, focus on taking care of yourself and enjoying life. You only get one shot at it. And finally, point no. 5 is to just buy and hold. One of the biggest advantages of investing in index funds is that you don't have to worry about picking individual stocks. Index funds track a specific market, such as the S&P 500, which represents the top 500 companies in the United States. By investing in an S&P 500 index fund, you're essentially investing in all of those companies at the same time. So if one company goes bankrupt, it won't affect your investment too much. However, that doesn't mean that there's no risk involved. In fact, there's a lot of risk involved. There have been times in history where the entire stock market has crashed. The worst crash was during the Great Depression in the 1930s. The Dow Jones Industrial Average dropped from 381 to 41. That's a decline of over 90%. But if you had just bought and held through that crash, you would have been rewarded with massive gains once the market recovered. The lesson here is that investing in the stock market is a long-term game. It's not something that you should try to get rich quick from. In fact, if you're trying to get rich quick from investing, then you're probably doing something wrong. Now, this doesn't mean that you can't make a lot of money in the stock market. In fact, many people have become millionaires by investing in the stock market. But it takes time. If you want to be one of those people, then you need to be patient. You need to stay calm and collected, and you need to hold on to your investments through thick and thin. Thank you guys so much for watching. I hope you enjoyed this video. And I'll see you in the next one.